Welcome to Iron Financial. This is the only place where we forge test company balance sheets to see if they'll crack under the pressure. Our job is to help you cut right through the market weakness and build a stronger, more resilient portfolio. Today, we are putting Conagra Brands, that's ticker CAG, on the anvil. You know the names Bird's Eye, Slim Jim, Duncan Hines. They're in every pantry in America. But this is a company with a massive, eye-popping dividend and a stock price that's making even long-term investors sweat. It is time for the stress test.
That's exactly right, because you have management on one side, talking up growth and telling a story of a successful turnaround. But then you look at the stock chart, and it's sitting there, stubbornly parked near its 52-week low. And the earnings? They're down. So what are we looking at here? This whole report reads like two completely different sets of blueprints for the same building. So the question we have to answer today is this. Is this a solid, reliable piece of infrastructure for your portfolio? A value giant with an ironclad dividend? Or is it just a pretty facade hiding some deep, dangerous structural problems? Let's find out.
And believe me, we are not just kicking the tires today. We are running a full top-to-bottom structural inspection. We're going to examine everything from the top-line revenue, the shiny exterior, all the way down to the concrete foundation of the balance sheet. This is our roadmap for the inspection. So let's start with Section 1 and dig into those conflicting blueprints that have the market so completely divided.
Okay, so let's set the scene. Conagra puts out its third quarter press release, and the CEO, a guy named Sean Connolly, he comes out and says he's pleased with the performance. That was his word, pleased. Now, you'd expect the market to react positively, right? But what happened? Nothing. A collective shrug. The stock barely budged, and it's still hovering dangerously close to its 52-week low. You see, when a CEO says things are going well, but the stock chart looks like a downward slope, that is the first massive sign of a crack in the story. It tells you that the market is reading a completely different set of blueprints, one that the press release seems to conveniently ignore.
And this slide illustrates that conflict perfectly. On the left, you have the official company story. Management is laser-focused on this one key metric, organic net sales growth. They're pointing to this as proof that the ship has finally been righted after a rough patch. But then you look at the right side. That's the market's reality. The market sees that adjusted earnings per share, the actual profit, missed what analysts were expecting. The market sees the company itself slashing its own full-year forecast, guiding it down to the low end. That doesn't exactly scream confidence, it screams damage control. The market is weighing the pretty story against the hard, cold numbers, and it's pretty clear it isn't buying what management is selling. This is the core conflict we're digging into.
All right, let's start our inspection with that exterior wall, the sales numbers. This is the first thing you see. On the surface, this is where the company's story seems to hold up. They're pointing to what they call a return to form, a sign of health. And honestly, this is the entire bull case right here in this next slide. If you're someone who believes in Conagra's future, this is the number you're hanging your hat on.
And there it is, positive 2.4% organic growth. Now this comes after a pretty tough previous quarter where their organic sales actually declined, so seeing a positive number is a big deal for them. This is the number the CEO is talking about in his press release. It's what the company wants you to focus on. Now this is driven by two things. A small but positive 0.5% increase in volume, meaning they sold slightly more stuff, and a 1.9% bump from price/mix, which is mostly them raising prices. A 2.4% gain isn't going to set the world on fire, but after a decline, any positive number can look like a major victory. This is the green shoot the bulls are pointing to. They're moving product again.
Whoa, hold on a second. We have to be crystal clear about what we're looking at here. That number was organic sales. That's a special, non-GAAP number that conveniently leaves out things like businesses they sold off and the impact of foreign currency. Now, let's look at the actual reported net sales, the number that includes everything, the one that has to follow the official accounting rules. That number is down nearly 2%. It's like the owner of a building bragging about the fantastic new paint job in the lobby while completely ignoring the fact that the building's overall square footage is shrinking because a whole floor is condemned. You can't just pick the numbers that look good and pretend the rest of the structure isn't crumbling. Total revenue is down, period.
But to be fair, the bulls would argue that the strength is in the core load-bearing segments. Take a look at this breakdown. Look at that first bar, refrigerated and frozen. That's their biggest business. It's up 3.6%. And what's really interesting here is that this growth was driven by a nearly 4% volume increase. Now that's important. That isn't just about jacking up prices on consumers. It means they are actually selling more frozen dinners and vegetables. It shows they're clawing back market share after struggling with supply chain problems. You also see their grocery and snacks and their food service segments showing solid, positive organic growth. This is the strength in the portfolio they always talk about. The core, they argue, is performing.
Okay, if that structure is so strong, if the core is so solid, then why is their own forecast for the full year so incredibly weak? This, to me, is the ultimate tell. It's the smoking gun. They're guiding the market to a full-year range of -1% to +1% organic growth. The midpoint of their own forecast is 0, flat. So after this one quarter of supposed strength, they're turning around and telling the market to expect, at best, to break even on growth for the entire year. If they truly believe this was a real turnaround, why would they tell investors to expect 0 growth? The math just doesn't add up. That tells me this quarter's growth isn't a new foundation being poured. It's just a quick patch and paint job on the facade.
All right, let's move on from the facade and head down into the engine room. We're talking about profitability. This is where a company does all the heavy lifting, where it has to turn all that revenue from the top line into actual spendable profit on the bottom line. Sales are great, but if it costs you more and more to make and sell your product, you've got a very serious problem. We need to see if this company's engine is running efficiently or if it's just burning through fuel and overheating without actually going anywhere. And there's that quote again. The CEO is pleased. He's pleased with the sales. Okay, fine. But is he pleased about the margins? Because that's where the real story is buried. Sales are one thing, but profit is what actually pays the bills. Profit funds that big dividend. Profit is what you use to pay down debt. Profit is what keeps the lights on and the machinery running. So let's pull back the curtain and see what the profit numbers really say about how pleased he should be.
This isn't just a crack in the engine block. This is a full-blown meltdown. Just look at this table. The change column on the right is a sea of bright red. Their adjusted operating margin, it fell over 200 basis points. That's huge. Adjusted gross margin, down over 100. And please, focus on that bottom line. Adjusted earnings per share, it has completely cratered, falling by almost 24%, from 51 cents a year ago down to just 39 cents now. So they're selling slightly more organic units, but they are making significantly less money on every single sale. This isn't an engine that's just running inefficiently. This is an engine that is on fire.
And this number right here is the reason why. The company is dealing with a 7% inflation rate on their cost of goods sold. That is the external pressure that is cracking the engine block. That is a massive, unrelenting headwind that they're fighting every single day. It's like trying to run a high-performance engine with sand in the fuel line. All of their efforts to raise prices and become more efficient are being completely eaten alive by the rising costs of ingredients, packaging, and shipping. And this isn't a temporary problem. The company itself is telling us to expect this level of inflation for the full year. So the margin meltdown we're seeing this quarter, that isn't a blip. That is the new, painful operating reality.
And now we come to the most important part of our inspection, the foundation. A company can have a nice-looking facade with growing organic sales, and it can even have an engine that's still sputtering along, even if it is on fire. But if the concrete foundation is cracked, the entire structure is at risk of a catastrophic collapse. For any company, that foundation is its balance sheet. This is where the real, underlying strength or weakness always lies.
Now, management will point you to these numbers, and to their credit, they have been doing some work here. They've paid down over $800 million in net debt over the past year, which is commendable. Their net leverage ratio is at 3.83x, which, while high, is generally considered manageable, and their debt-to-equity ratio is almost perfectly balanced. This is the financial equivalent of repainting and patching up all the visible concrete on the outside of the building. It looks good from a distance. But at Iron Financial, we don't just look from a distance. We look deeper. We bring out the heavy equipment for the real stress tests.
Let's start with the first, most basic stress test, liquidity. This answers the most fundamental question in business. Can you pay your bills for the next 12 months? Forget about 5-year growth plans and turnaround stories. Can you cover your immediate debts? The current ratio is the metric that gives us that answer. Plain and simple, anything under 1.0 is a warning sign.
This right here is a major structural flaw. A reading of 0.89 is a failing grade. It's not a close call. It means that for every single dollar in bills, payroll, and short-term debt they owe in the next year, they only have 89 cents in cash and other liquid assets available to cover it. The foundation is already underwater. This isn't just some abstract accounting issue. This has real-world consequences. It means they might be forced to borrow even more money, probably at higher interest rates, or even sell off parts of the business just to meet their day-to-day obligations. It's a sign of serious strain.
Next, let's look at return on equity. This test is crucial. It tells us how efficiently the company is using its shareholders' money to generate a profit. And the answer for Conagra is, well, it isn't. The return is negative.
Just think about what that means for a second. As an investor, you give them $1 of your hard-earned money, and by the end of the year, their operations have managed to turn it into less than 99 cents. They are actively making your investment shrink. This isn't just a hairline crack in the foundation, this is a sign of rot deep inside the rebar. It shows a fundamental failure in the business model's ability to create wealth for its owners.
Okay, now for the final, definitive stress test. We're bringing out the big one, the Altman Z-Score. This isn't our opinion, this isn't a guess. This is a formula developed way back in the 1960s by a professor named Edward Altman, and over the decades, it's become the grim reaper of financial models. It has a frighteningly accurate track record of predicting which companies are heading for the corporate graveyard. It looks at everything, profitability, leverage, liquidity, all of it, and it combines it into one single score that tells you the probability of failure. This model doesn't pull any punches.
This is the inspection result that should matter most to any potential investor, a score of 1.46. Now, as the definition says, any score below 1.8 puts a company squarely in the distress zone. Let me be crystal clear about what this means. The industry standard model for predicting bankruptcies is screaming that Conagra is at a high risk of going bankrupt within the next 2 years. The foundation isn't just cracked, it is definitively failing the stress test. This is, without a doubt, the single biggest red flag in this entire inspection report.
And yet, after all that, despite the margin meltdown, despite failing the basic liquidity test, despite the fact that it's destroying shareholder value, and despite the Altman Z-Score screaming distress, there is one massive, seemingly load-bearing pillar that income investors always point to as a sign of unshakable, permanent strength: the dividend. For many investors, this is the only thing they see.
And you simply cannot ignore this data. An annual dividend of $1.40 per share results in a current yield of almost 9%. That is an enormous return in any market environment, and it comes from a company that has paid its shareholders like clockwork every single quarter for over half a century. 51 years. Think about that. They paid it through the dot-com bust, they paid it through the 2008 financial crisis, they paid it through the pandemic. For a dividend investor, that kind of track record is like scripture. It looks like a pillar made of solid granite.
It's not a pillar, it's a value trap. It's bait on a hook. That 8.91% yield isn't a sign of a strong, healthy company. It's a simple mathematical result of a collapsing stock price. As the stock goes down, the yield goes up. And now, look at this payout ratio. They're paying out 73% of their earnings to shareholders. This right here connects all the dots. This explains the current ratio problem we just saw. They're sending so much cash out the door to shareholders that they don't have enough left over to reliably cover their own bills. So I have to ask you, is this responsible capital management, or is this just hush money paid to shareholders to try and keep them from noticing that the building is about to collapse?
Okay, our inspection is complete. It is time to lay out the final report. We have the company's official blueprint, their narrative, on one side. And on the other, we have the results of our comprehensive, no-holds-barred stress test. It is time to weigh the evidence and see where things stand. The bull case, the company's blueprint, rests on the enduring power of its iconic brand portfolio and the hope that this recent return to organic sales growth is the real beginning of a sustainable trend. The bulls believe that management can navigate the debt and that the 51-year history of paying that dividend is a sacred promise they will continue to honor, rewarding shareholders for their patience. The bear case, however, is based on cold, hard math. The balance sheet is flashing multiple, high-priority red warnings for severe financial distress. We're talking about the current ratio, the negative return on equity, and most importantly, that damning Altman Z-Score. The profitability engine is failing under the immense pressure of inflation, with margins just collapsing. From this perspective, that huge dividend isn't a reward for your loyalty, it's the company bleeding out cash it desperately needs to call an emergency contractor and start fixing its crumbling foundation.
So here is the final call from our inspection. The facade shows some fresh paint with that one organic sales number, but our stress test has revealed critical, undeniable flaws in the foundation of this company. So the question for you is this: is this an opportunity to buy a classic fixer-upper with a great income stream, believing the structure is sound enough to be repaired over time, or is it a structure that's just one economic shock, one more bout of high inflation, or a sudden dip in consumer spending away from a catastrophic collapse? That's our analysis. Now you have the tools from our inspection to make the call for your portfolio. For Iron Financial, we'll see you on the next stress test.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.